All clear. Perfect. Awesome, guys. So today we're going to take a look at market maker models. Market maker models can be extremely difficult, and um, you can make it really difficult for yourself to understand these things. There's a lot of elements that goes into market maker models, but at the same time, you can really simplify things to really get a clear understanding of market maker models. And once you understand the basics of the market maker models, you can then dive a little bit more in depth into the little finer intricacies of these market maker models, whether it's a buy or sell program, and so on and so forth. So what I'm going to do is I'm going to explain everything today to you guys um, in a simple way. And at the end of this session, we are going to take a look at a couple of these market maker models playing out over the past couple of weeks in the markets in real time. So, yeah, without any further ado, guys, let's get right into it. So, we have to understand that everything always starts with an original accumulation, right? So, a market maker model starts with an original accumulation, and I'm going to highlight the most important ones to focus on first. On the top, we'll have a smart money reversal, and on the bottom, we'll have our terminus. This three steps right here, this is the most simplistic way to look at a market maker model if you are not familiar with them already. So we'll get into a bit more depth in a moment, but we really just need everybody to get a good understanding of what a market maker model is. Excellent. So this is the three phases of a market maker model that is most important to a new trader to really understand what the market is busy doing, right? So this is the original accumulation. The market trades higher into a higher time frame key level. We see the smart money reversal takes place here, and then the end objective is this terminus level, where the market offloads the orders below the original accumulation. All right. And we as traders, if we understand these things um, and how to expect them, kind of read the institutional order flow that they cannot really hide from us, we can definitely profit from these moves. So even though this is starting off really basic, we'll get a little bit more in depth in a moment. All right. So I'm trying to make it step by step so that I don't confuse anybody. So it's really basic at the moment, but we'll get more uh, more in depth with it. Right. So this is our original accumulation. This is our smart money reversal. We'll have this also in yellow, and in terminus is down here. So in the middle of these, we have our accumulation levels, right, where the market reaccumulates. So this, for example, would be our first phase of accumulation. Just make it a different color so we can see, right? Okay, so this would be the first phase of accumulation. Then we'd have a second phase of accumulation. And this is on the left side of the curve, right? So if we see the original accumulation, the smart money reversal and terminus, everything on the left side, we consider this then the buy side of the curve, right? So this is the buy side of the curve. And everything on the right-hand side would be our distribution or sell side of the curve. So this is the accumulation phases in the buy side of the curve. And on the sell side of the curve, we'd have the distribution phases. So just like we have the first phase of accumulation on the left-hand side, on the right-hand side, we'll have the first phase of distribution. Then we'd have the second phase of distribution. All right. So for those of you that have learned a couple entry models or maybe learned some certain things about market maker models before, you'd have probably heard over the years that ICT's most his favorite one model that he would prefer to trade for his, like, if he had to choose one single model to trade his entire life, he said it's the second phase of accumulation or the second phase of distribution, very well known as the silver bullet, right? So the silver bullet takes place here on the buy side of the curve towards the higher time frame key level, right? So this is the silver bullet on the buy side of the curve. And then on the sell side of the curve, this would be your silver bullet, right? So as mentioned, you can go into all the finer or smaller intricacies and refine and really become a market maker model specialist and really spend a lot of quality time on these market maker models. Okay. But this is the basic structure of the market when we take a look at market maker models. So the first, the second phase of accumulation. Let's make this green. And then the first and the second phase of distribution, right? Now, we have to understand, guys, that it is pretty important that there could also be a third phase of distribution and a fourth phase. Nothing says that there should only be one and two phases of an accumulation. There can be multiple phases of an accumulation, up to infinite number, right? Until we hit a higher time frame PDA and until we hit a real turning point where we'd have a short-term high, intermediate-term high, low-risk sell, market structure shift, new dealing ranges forming, and these things, right? Then we can really anticipate the market going from a buy side of the curve into a sell side of the curve. But it's not to say that there has been one or two phases. It's time for a market reversal now. That is really not um, what it's all about, right? It's about the most important things. It's about the original accumulation, the smart money reversal in the higher time frame key level, and then terminus. These levels in between, they can be numerous, and we can take each and every one of them as a single new trading opportunity. All right. The silver bullet is one that I personally myself like. I've made a Instagram video in the past where we've explained that the leg that comes right after the low risk buy, the second leg of distribution or the second leg of accumulation, these legs tend to be super high probability, right? So um, I really like to focus on the move that occurs after the smart money reversal. You don't always have to buy and sell the low risk buy or the low risk sell. You can wait for a dealing range to form there, and within that range, you can work with the premium discount and form your own models. So we'll go into more depth in the bootcamp on these specific models. But below, I have a quick example of a market maker buy model for you
Hey,
guys.
Calvin, can you go up just a little bit so I can explain something? Also, can you
100%.
let some people in from the weight room while I do so?
Perfect. Will do.
Yeah, so Calvin mentioned a couple of key things. Now, all these terms might be pretty, scary at first, but basically, all you need in order to spot a market maker model is just a couple of things. One, you need your higher time frame order flow, right? So let's imagine that we have some order flow, we're bearish, right? And then the second thing that you would need is your higher time frame PD array. So let's say that that's a fair value gap or something like that. And if you take a look at this example that I've drawn, the smart money reversal is just when price changes its state of delivery from, in this example, from buy side to sell side at that PD array, right? Because price changes its state of delivery from PD arrays, and all this original consolidation is just the start of that delivery from when price hit that low of that range from the higher time frame order flow until it went up to that PD array, right? So that's what we call that that accumulation over there. And then price goes up to that PD array, which is where the smart money reversal occurs. And then that terminus is when price just takes out this level, or that opposing side of the market maker model stops, right? So that's just a super simple way of looking at all of that stuff, and those are kind of the building blocks of what you need for a market maker model.
Yeah, 100%. I can add to that quickly.
Yeah,
Thanks for mentioning vision. So, what Vision is trying to say is, I think a very simple way to explain it as well is just looking at a downtrend, right? Layman's terms, this doesn't have to be ICT correlated or connected in that sense. Just everybody in the trading world do know about uptrend and a downtrend, right? We have a series of low highs and lower lows, as simple as this for this moment, right? Then you'd have your higher time frame key level, and that is where the market usually give you or present a potential smart money reversal. And this is where our first dealing range starts to form. The market comes back to a discount array. In other words, our low risk buy opportunity, and then the market would trade higher. So essentially, if we take a look at this bell curve right here, and we try to identify the same thing here, we could see that the market has been on the sell side of the curve down here and is now transitioning into a buy side of the curve, right? So the market transitioning into a buy side of the curve, we would look for the accumulation and distribution phases within this market, right? Understanding that this is our short-term low, intermediate-term low that traded into the actual PD array, and then that market structure shift, which came in with a new dealing range being created, the low risk buy here. This is a low risk buy opportunity where you can potentially buy something like a discount array within this dealing range, right? Now, please keep in mind, many traders get this completely wrong, guys. The low risk buy, let me mark it up for you guys. Low risk buy. The low risk buy, guys, is not telling you to buy because it is low risk. It is actually the complete opposite. The low risk buy tells you to buy with low risk, if that makes sense. Because we are not 110% sure just yet that this market is going to give us or present us with a full trend change. So for me, as I've mentioned before and mentioned just a little bit earlier, I personally like for this dealing range to form. Once this dealing range has formed, I once again have premium discount. I have discount arrays to work with, and I usually like to position myself in this league, right? So before I get ahead of myself, let's just do this. All right. So all of this can be seen as just a lower time frame fractal of this entire schematic over here, right? Or in other words, just this one inversed, right? So it doesn't have to be complicated. This is the leg right after the low risk buy. This is my favorite leg to trade. I like to trade this PD array and I like to buy the market long, right? So an expansion, a retracement, and we expect continuation towards terminus over here. All
yeah,
right.
it's a good way of putting it, Kelvin. It's not a low risk buy because there's less risk there, but rather it's
Hmm,
more of a high return buy because you got
that
in
is
early.
correct.
Yeah,
Yeah, this is a really good entry, guys. I'm going to be honest with you. As Vision says, this is a really good entry. You get one of the lowest entries in the model. It is beautiful. And if you can do this consistently, it's really great. But you have to keep in mind, sometimes, guys, the market does exactly this. It trades higher, it induces traders. Many retail traders would see the market structure shift, and then the market just breaks down and continue to trade lower, right? And we don't have there's no way to tell if this is going to hold or fail beforehand, right? In the live market, it's really, really difficult. Like it's easy to trade a model, right? Short term, intermediate term, low risk buy. It's easy being a buyer with a stop loss and a TP. That's not a difficult part. But the thing is, you have to understand that in the live markets, the market could potentially weak you out once more and then trade higher in any case, right? And it's very frustrating. That has happened to me before. So I've learned over the years that, okay, fair enough. On this one, I still want to trade these positions, but I will only trade them with half risk, right? Once we have a power of two confirmation, I can add a little bit there, another 0.5% risk. Now I've built a position that has also confirmed itself that we are trading towards a terminus over here, or in other words, the original accumulation which took place here. Okay. So then this scenario, the second scenario, so you guys can absolutely still buy the low risk buy, but I just wanted to make it clear, and Visioner, I believe, has helped with that in the understanding of what a low risk buy actually is. Okay. So please keep that in mind, guys. The low risk buy doesn't mean execute half of your portfolio long because you have a low risk buy. It absolutely means the exact opposite. Execute with low risk because there's not a true 100% confirmation or a 100% way to know that the market is trading bullish, right? So for me, I really like to focus on the second leg, well, this one right here, because now we've confirmed a market structure shift in here. We've also confirmed a power of two continuation where this becomes a propulsion block for higher prices. And this is something that I've learned to love over the years. And I've really fell in love with this model. And it is super, super powerful. Yes, no model is 100% guaranteed, but at the end of the day, this is a very powerful um, entry model, right? So then we have this candle, which becomes a propulsion block. And remember, down close candles on the buy side of the curve should support price higher. All right. And just the same as these up close candles, right? Exactly the same as these up close candles has supported price lower on the sell side of the curve, right? So this should be a green candle. And this is institutional order flow. And we'll get into more of this in a moment. That's actually not going to work the way I wanted to, but it's fine. Let's just put a small bit there and a small bit there. And these institutional order flow candles supported price low on the sell side of the curve. And now we expect these down close candles to support price high on the buy side of the curve. So what we would call this, we'd mark it up as institutional order flow, or you could potentially mark it up like I have created mine as a propulsion block. And I use this specific array right here because the first thing I'm looking for in a smart money reversal is the change in state of delivery. So this is the only two markings that I have out of all of these markings that has colored, that is colored. So this one is red, and it's red for a reason because it draws my attention right to that level in the moment. And the same with this propulsion block. Okay. So the CSD and the propulsion block to me is super, super important, super valuable. And it's because this is now the second range, right? The second expansion after the low risk sell, a low risk buy. So the second leg, the market comes back to this propulsion block or discount raise, etc. And I like to position myself long in the market right here. Now I have a double confirmation. The first confirmation is market structure shift right here. The second confirmation is power of two and a new dealing range, right? So now we can confidently say, guys, if we take a look at the schematic and we rewrite it up here, we can clearly see the market trading lower. There's our first dealing range, right? Potential smart money reversal with the low risk buy down here. But it's not totally confirmed yet, right? But as soon as the market breaks this high, that is truly now a confirmation to me where we've had a low, a high, a lower high, and a higher high, where we've gone from um, lower lows and lower highs, right, into lower or higher highs and higher lows. So the market has truly, truly changed its direction, right? And that is why I like to position myself personally in this leg. This is the highest probability trading legs that I've personally um, experienced. All right. So that out of the way, this could also potentially now be your silver bullet, trading back towards the original accumulation over there. That is our first target. And we'll soon get into a nice example of this, guys, on the live markets. Okay,
Can you check the weight room one more time, Calvin?
perfect. Let me do that. Okay, I'm admitting more people. That's perfect. Excellent. So, guys, if you have any questions, most welcome to ask your questions. And don't worry, there's no such thing as a stupid question. I've already asked them all a couple of years ago. So please feel free to interact and to ask your questions, and we'll get your questions answered. All right. Market maker models, as I've explained, it can be really difficult, and there's a lot of intricacies to these market maker models, but you can refine it and you can make it really simple and easy to understand, right? Which we've done right here, where um, we truly break it down to three simple steps or highlight the three most important steps of this bell curve, right? Original accumulation, smart and reversal terminus. And then we have our accumulation phases and distribution phases in the middle of it all. Now, then we have this sequence of events where we get the smart money reversal in here, which is a case study that everybody can go and study. And I would really suggest you guys do study the smart money reversal, the low risk, or the short term I, intermediate term I, and the short term I over here, the low risk sell, right? So this is a case study in and of itself. Okay. And then you can take a look at a different case study on how the market reaccumulates and redistributes price, because it's not always just one simple, straightforward way how these algorithms distribute price, right? There's usually an accumulation, a manipulation, a distribution into inefficiencies. So you have clear ranges to work with, etc. And these is different independent case studies that really um, goes hand in hand with the entire market maker model, right? But if you truly spend quality time on the smart money reversal, you will be you'll have the confidence to execute into live markets, first of all, and second of all, your brain literally builds these neural networks or memory lanes where you know what it looks like and how they develop in real time. And once you understand these things, it's easier for you to execute. You have confidence to execute. You know what is the risks you are taking and what is the benefits to positioning yourself in the smart money reversal, etc. And it works the exact same way with the first phase of distribution. And then there's a whole different case study. So there's one case study in here, one case study in here, the redistribution and reaccumulation phases, right? And then there's the silver bullet, which is a different case study in and of itself, where the market, if we create this entire range in 25%, this is 25, 50, 75, and 100, then we know how the market distributes in the final portion of the range, right? And this is the ICT silver bullet, okay? And these um, once you've studied these events 10, 15 times each, right, then it becomes really, really clear to you guys what it looks like, what is the true characteristics that you want to see, what is the characteristics of the ones that are failing doing backtesting, what is the characteristics of the ones that usually play out so well. You are able to identify them, you can position yourself in them, you can execute with confidence, and you win your trade. That's a beautiful feeling, especially to a new trader once you really gather these statistics and you truly studied it for a while before you just go into the live markets and apply risk left and right on everything you see. Okay, so
You have a
we can.
question in the chat, Calvin,
Okay,
from
perfect.
Patrick.
Let's take. Okay, on what time frame do you look for the market maker model most of the time? I find it hard to align the time frames and only see it in hindsight. 100%, Patrick. That's a good question. Okay. That is exactly what I was going into right now. So, yeah, now there's something called time frame alignment, guys. Okay. Time frame alignment. This is something that I myself, on a personal level, I've struggled with this in the past. Okay. It took me countless of backtesting sessions to truly understand what I'm looking for. Okay. And full circle, 2.5 years later, trading these market maker models, Vision can testify we've developed two really simple trading models. Okay. And these two trading models consist of all of these building blocks and pieces together in two simple trading models, right? Which is high probability. And we know we have a statistical edge in these models. But way back then, 2 years ago, I did not have these models. I didn't have the understanding that we have today. Okay. And so it was really difficult for me. Similar to Patrick, I was able to see the market maker models beautifully playing out in hindsight, right? But it was so difficult for me to really see it in live markets and actually position myself in them to capitalize on the expected move. All right. So I've spent a lot of time on this topic now, which is time frame alignment. And it is not something that is as difficult as I once thought it was. It is actually, once I've studied time frame alignment and how the markets connect these pieces together, then it becomes pretty clear and easy and straightforward. And this really solved the whole confusion for me back then because I saw a lot of times people trading market maker models on the 4 hour. The other guys are trading it on the 1 minute NQ charts, right? Then I saw a whole group of other traders that are position and swing trading, trading it on the weekly time frames and weekly charts. At the end of the day, guys, the market maker model, and this was really confusing to me, but I've learned the market maker model, whether it's a more monthly chart, a 1 minute chart, a weekly chart, a 1 hour chart, 15-minute chart, intraday charts, it's all the same. The market maker model always remains the exact same. It's just a way you would utilize your higher time frame key levels, your smart money reversal turning points, and the way you confirm the smart money reversal on the lower time frame, which set you up for success. Okay, so let me break it down to you guys quickly. So on the monthly, so if you spot a monthly market maker model, right, you would go look for executions or confirmations on the lower time frames, right? So if you have a monthly market maker buy model, and you want to look for a potential entry, but you are not sure where are you going to look for your entry. Is it now going to be the daily, the 4 hour, the 1 hour, the 15 minute? You are not quite sure where to get involved, but you are able to see it visually on the monthly. You can see there's a whole major market maker model playing out. You want to get involved, but you're not quite sure where. So then you drop down from the monthly, you go into the daily time frame, right? And on the daily time frame, that is where you could potentially get interested in a confirmation. And from the daily, you can just refine it into a specific session and there's your execution. Okay. But we'll get into that in a moment. Okay. So the monthly, you drop down to the daily. That is where you look for your confirmation on the trend shift or a daily PDA. So let's put it like this, just to give you guys a simple illustration quickly. Here's that bell curve, right? Here's that bell curve. This is the monthly time frame, okay, or the daily. It doesn't really matter, but I just want to choose something static to quickly help you with it, okay? So let's just say this is the monthly buy side of the curve. We are able to see it, right? We even know where's the original accumulation, where the original accumulation took place. So this is a major monthly market maker model, right? We want to position ourselves in here. We want to get involved long, right? So what we'd have to do is we'd have to go down to the daily time frame and find ourselves a nice PD array. Once we see the market coming down to this daily PD array, right? Let's say the market trades higher, the market works itself down to this daily inefficiency, this daily bullish fair value gap, right? This is exactly where we now go from the monthly sets the trend, right? The daily is the array we will work with. And on the daily array, we'll follow the time frame alignment model, which we are getting into now. We'll go into the 1 hour time frame. and we will find ourselves a good execution within one of the two kill zones, which would likely be London and New York session kill zone. Okay, so we'll get into more details in just a minute, but I'm just trying to explain to you, you've identified the monthly buy side of the curve, or it could potentially even be the monthly sell side of the curve, right? You'd look for a daily KD array, daily PD array, and a 1 hour execution on a certain session. Okay, and that's pretty much how it works, and it's really straightforward. So from the monthly, you go to the daily and look for your key levels. From the weekly, you go into the 4 hour time frame and you look for your key levels and confirmations. So what I mean by that is, let's say this is a weekly sell side of the curve. We've already identified this market is on the sell side of the curve, right? On the weekly. So now we just want to take the higher time frame continuation of this. Okay. So what we'd have here is we'd have a dealing range on the weekly time frame. Okay. And then we'd have a 4 hour premium array in here. Okay. So we would now go to the 4 hour time frame and see the market retrace in here, right? We get our short term high crouching before the array, our intermediate term high, our dealing range, and our low risk sell. And that is where we could potentially get involved. Or you could potentially wait for this dealing range to play out to truly confirm the trend change, like I have learned to do over the past couple of years. And I look for a trading opportunity within this last or second leg. Okay. So many traders would position themselves in the low risk sell over there, but I like to position myself in the leg that comes after. This to me is a much, much, much higher probability leg, and it usually would also be, it could potentially be a silver bullet and such. Okay. So here we have a weekly direction with a 4 hour key level, and then what we do in here on this most crucial stage where the market flips over, let me give you guys a quick example of what takes place here. Okay. So this would be, okay, let me just move it all over this way. Okay. So here, what we'd see is we'd potentially see a up-close candle, right? Let me just make it thick so everybody can see this. Okay, so that is our up-close candle, which trades higher into the actual leg, or into the actual PD array, sorry. And then the very next candle would be this big bearish candle, right? I'm gonna shift this over one more. Yeah, let's do that. Okay, this would be that red candle, right? So this is gonna be my 4 hour confirmation. Can I make it transparent? Still want to keep it dark. Perfect. All right, guys. So at this point in time, it is pretty crucial to understand that this is that moment where the market really change its direction from the buy side of the curve in here, right, into the sell side of the curve. And remember, the weekly time frame is already just in that sell side of the curve, that sell program, right? So we have just successfully positioned ourselves in a weekly direction in a 4 hour key level with a 4 hour confirmation. This red candle is a 4 hour confirmation, right? So you can take it a step further and go even lower into this on the 15-minute, because that is what comes next, right? So on the monthly, you go to the daily, the weekly, you go to the 4 hour, the daily, You go into the 1 hour, and then you'd have monthly, weekly, daily 4 hour goes into the 15-minute time frame. The 1 hour goes into the 5 minute time frame, etc. Okay, so please understand this on the higher time frame is the weekly. This is a 4 hour premium array. Okay, as you can see, we've measured this range from swing high to swing low. We have our premium array, then the 4 hour premium array, and we look for a confirmation in here. So you can use two different execution methods. You could potentially wait for a 4 hour confirmation. This would just be your change in state of delivery. Or you could go into the 15-minute time frame. And let me give you guys an example of that. So if we take a look at this sequence of events taking place here, we'd have this on the 15-minute, right? That trades into the key level, and this is our 15-minute dealing range. This is the 15-minute time frame. We are now taking a look at exactly this green and red candle. This is exactly what it looks like. This is that green candle, and this is that big red candle, right? So what you can do is on the lower time frame within, let's say this was London session and this is New York session, the red candle. So London green, New York red candle, we can see that we have a distribution taking place here on the New York Open. We have a nice dealing range. The market trades back towards this, and we can just simply take the continuation on the 15-minute time frame. This one right here, the low risk sell. Or you could potentially wait for this to continue a daily candle close. The following day, you would position yourself either in London or New York session for the silver bullet continuation to clear terminus down here. Okay, it may sound and it may look very difficult. Okay, it may look challenging, but it really, really, really isn't. The moment you spend some time on this time frame alignment um, levels, right? I've given you guys the sequence. Looks like I'm going to have to do it over. Um, the daily goes into the 1 hour, the 4 hour into the 15-minute, the one the 1 hour into the 5 minute, and then the 15-minute into the 1 minute. All right, there we go. So this is the sequence if you want to follow time frame alignment, and this really helps you to define where to execute within these models, market maker buy and sell models. Okay. So Patrick, I hope that has helped you. Let me know if it has at least shined some light on where you need to go and investigate, right? You need to go and investigate the time frame alignments relationship between the higher time frame narrative and the lower time frame context. Okay, because essentially there's a disconnect for you now at the moment. I believe as you've explained, you are able to see the market maker model, but you're not quite sure where to get involved. Or you could potentially see afterwards, oh, wow, this was a really good entry, but too bad the market has already hit the TP. In hindsight, right? You are able to see these things, but you are unable or not confident to really position yourself in these um, opportunities. All right, so at least now through time frame alignment, you have a really good idea where to go and look at. Okay, so for me, I use the higher time frame key levels, and then I would, if it's a monthly downtrend, a weekly, a daily, a 4 hour. If this is a 4 hour downtrend, just layman's simple terms so everybody can understand, 4 hour bearish institutional order flow or 4 hour downtrend, right? I would look for a 15-minute premium array. And inside this 15-minute premium array, I can then go down into the 1 minute, right? And look for a nice dealing range, as we can see in this schematic over here, right? This one here. We can see there's a 15-minute swing high, 15-minute swing low, and the market has surely created this dealing range in here. Premium array, ICT breaker block, ICT fair value gap, right? And we can execute the low risk sell in Okay, so this is the way I could do it. I would either utilize the 15-minute right here and just sell because this is a new candle open. It would come back, immediate rebalance. I would sell the market right here, stop loss there and TP there, right? Looking for 1 to 2. Or I can go into the actual 1 minute and refine it like this. Small dealing range, break a block, um, ICT inefficiency, overlapping arrays, fair value, and you can make it really complicated for yourself if you really want to, or you can really just execute what is clearly in front of you, and you have that double confirmation because you are actually trading in line with institutional order flow, right? Where these up close candles every time supports price lower on the sell side of the curve, right? Until the market proves us wrong. Okay, so yes, sometimes the market will prove you wrong and you would lose the position, but at the end of the day, it's much better trading the continuations with or in line with the higher time frame institutional order flow than really trading against it, right? Let's see the comments. Okay. So does the time frame alignment have to be in order, monthly, daily, 1 hour, 5 minute, or can you just frame models using the hierarchy of monthly, weekly, daily, 4 hour, etc.? Does the time frame alignment have to be in that order? Well, to be honest with you, Offense, I'm not 100%. I don't quite understand your question. But to me, I just use it in order, right? And let's take a quick look at, we are going into the live examples now, okay? This is a major market maker model playing out here, right? Or JPY recently, okay? And if we go to even to, this is the weekly time frame, if we go to the higher time frames, we are able to see a major market maker model playing out here too, right? So this now is the buy side of the curve. Let's just make it green. And this should be terminus, right? So we'll go into the actual breakdowns now. We'll take a quick look at detailed examples, but I just want to help you to understand this quickly. Offensive for me personally, if this is a monthly leg that I'm working with, I would look for premium and discount rates, right? So let's say we have this monthly inefficiency in here, just as an example, right? It's a monthly leg, a monthly dealing range, a monthly inefficiency. Then from here, I would go down to the daily. Okay. I would not go and fiddle with other different time frames. I mean, it's not wrong. It's really not wrong. Depending on your experience, depending on your experience, it's really not wrong. And I can already frame you. Okay, so this is the monthly key level, right? And then from here, we'd go into the daily. And what do we see here on the daily? We can see a stop run. Sell stops has been taken, right? Let me just delete the block. Sell stops has been taken down here, right? And what did we do? We created a new dealing range. We created a new dealing range on the daily time frame. This in and of itself, the change in state of delivery is a confirmation. Okay. So this is our change in state of delivery. This would be the buy side of the curve, right? Terminus, or the original accumulation took place here. Or yes, original consolidation took place there. First phase of distribution, second phase of distribution, low risk. This is order pairing, sell stops. This is the market structure shift that we can see, the change in state of delivery with the ICT breaker block, right? And in here, I would look to just position myself with a low risk entry, low risk buy. I would look to position myself in a low risk buy opportunity here, target this as a potential low hanging fruit, and then ultimately leave a small runner for this to capture whatever the RR would be, right? So there's a potential opportunity in there. And I've used two time frames. I've used the monthly dealing range, right? From the swing low to the swing high with the monthly swing low, swing high with the monthly array. Okay. Then I've went to the daily and I've seen beautiful daily dealing range. Okay. In here. So from here, you can go into the 1 hour. I'm not sure we'd be able to go that far back on the 1 hour. No, we won't. But then you can just go to the 1 hour and you would look for a refined entry inside of a specific uh, kill zone for the day. Okay. But it's not even necessary. So um, I have two different execution methods, right? You can use a refined entry. So you'd have a refined entry. Okay. So you've used the monthly, right? You've went into the daily to find your confirmation. And now in here, once you have your confirmation, you can go into the 1 hour. There's not a problem with that at all. Okay. You go into the 1 hour and choose London session or New York session and look for price action to confirm on the lower time frame that the market is now going to the buy side of the curve. This would potentially look like an accumulation, a manipulation, right? Accumulation, manipulation, and then comes the distribution. This now is the 1 hour execution, right? Or you could potentially just take the structural entry, which is the other entry, okay? You don't always have to use refined entries because now, if you go to the 1 hour to refine, then what's stopping you to go into the 5 minute to refine? And if you go into the 5 minute, what is stopping you into going into the 1 minute to refine? You know, this is the confusion, or there's a disconnect here. People try to over refine and then the market runs towards the TP and they never got an entry because they waited for the monthly, the daily, the 4 hour, the 1 hour, the 15 minute, the 5 minute, the 1 minute inverse and fair value gap, right? And they just completely missed the entire move. Don't be that guy. Okay. Don't be that guy. Be the guy that see the market maker model, you find your key level, you find your daily confirmation, and now you look for your 1 hour execution. As simple as that. And you would have great success capturing the entire move, right? Instead of being the 1 minute trader in here that gets wicked out 3 times and then try to capture the move and then have one good win, but you've already lost 3% just trying to get a 1 minute entry, right? Don't be that guy. I've been that guy. I can talk out of experience. Don't be the 1 minute trader, especially not on the forex markets. If you want to trade the 1 minute time frame, please, you are most welcome to trade NQ and ES on the 1 minute time frame. It's a different market with different characteristics. On the forex market, you stay away from the 1 minute time frame. You absolutely focus on the 5 and the 15 minute and the 1 hour for executions. Now, there's a lot of details that goes into this, and there's so much I can give you guys, so much value I can give you guys. Okay, so we'd have to distinguish the narrative and the context quickly. So the monthly, the daily, the weekly, that's your narrative. The 4 hour, the 1 hour, the 15 minute, and the 5 minute. Those four time frames is your execution on the forex market, right? You can use a 15 minute to execute. You can use a 1 hour to execute. But if you want to be the guy trading the 1 minute time frame on forex, it's not impossible, right? I'm not saying it's impossible. You can get it, you can do it, you can get a beautiful entry. But out of 8 years experience, I can also confidently tell you guys that on the 1 minute time frame, you'll get wicked out 4 times before you capture the actual move. Okay, so just weigh it up, the pros and the cons. Am I going to execute on the 15 minute time frame? I see the entry, I take it. All right. Let me give you guys a quick example. I'm just going to post one image for you quickly before we go into more detail on the actual market maker models. I want to share an execution that I've taken with the group during this week, and I've shared it publicly with the group. And eye of day. Okay, here we go. Perfect. Let me copy this image. This was silver on the 15-minute time frame, I believe. Okay. Look at this. Look at this entry, guys. Okay. This is silver on the 15-minute time frame. I'm not going into the 1 minute, the 2 minute, the 3 minute, the 30-second and 10-second charts to capture the move. This is a 15-minute time frame. This is where I'm executing with a confirmed high of day. This is the Asian range, right? Asian session high, Asian session low. Asian session low was the low hanging fruit. Move stops to break even and then let the rest run towards the TP. This is a handsome 3-4 hour trade, okay, that we've taken. But at the same time, look at the structure that I've been working with. The higher time frame order flow, the retracement into, you see this big red block, Okay, it's a little bit big here because it's a daily or weekly level, etc. But here we can see a beautiful dealing range forming. Here's the low risk sell. Calvin did not sell the low risk sell. If I did, it would have been awesome, right? It would have been quite cool bragging in hindsight, right? But the reality is sometimes this thing just blasts through and you lose the trade. So I've learned that I'm staying away from the 1 minute time frame and I'm staying away from the low risk sell. Or if I do want to take the low risk sell, if I'm really confident, then I'll take a half position, right? Half risk. But anyways, nonetheless, this is the power of two confirmation we've executed here. Silver has ran down towards the Asian lows, move stops to break even, able to take a one-to-one, whatever the case may be, and etc. Okay, but this is a live example of the 4th of March. You guys can go and look at the price action here. Go look at gold, silver on the 4th of March. Okay. Anyway, this is a really good explanation of you don't have to over refine it. Okay. 15-minute is the lowest time frame I'll go. Okay. So I hope this helps you guys. Let me read the comments quickly. And thank you for asking your questions, guys. It helps me to deliver value to you. I can sit here and talk about topics that's not really your issue or your struggles, right? And then we just sit here and I talk a lot, but it's not productive. So thank you for interacting and asking your questions. Okay, awesome. Let's move on with the question. So 4 hour CST or 15-minute structure. Yes, Damien. Perfect. Perfect, Damien. I love it. I love a 4 hour confirmation and a 15-minute structural entry, 15-minute market structure shift after a 4 hour PD array, or 4 hour market maker buy model with a 4 hour discount array, 4 hour fair value gap, 15-minute dealing range. Here we go, right? The image that I've just posted with for you guys, this could as well be it, right? Let's say this is a 4 hour level, 15-minute dealing range, market structure shift, second leg is coming in here, right? We can position ourselves anywhere in this leg. Okay, this is a high probability leg. Okay, and you can trade it. So yes, 4 hour level, 15-minute market structure shift with a you can decide then do you want to take the low risk sell or do you want to take the second leg, right? Because essentially the second leg is higher quality than the low risk sell, and because the market is more so confirmed in that direction already. All right, at that point in time, once the market really gives you um, that sequence of events. So let's see, based on your example, once you have 4 hour CST, is it valid to look for 15-minute institutional order flow or do you wait for the 4 hour institutional order flow? Offensive perfect, right? So you understand it in your question. I can already see you understand it perfectly. And in your question, you are actually answering yourself. You can use both. You can use 15-minute institutional order flow candles, right? From the 4 hour change in state of delivery. You can go into the 15-minute to find a refined entry, all right? But if you already have a 4 hour CSD closure, you can execute right there and call it a structural entry. You don't need anything else. Because let's take this example of him. So let's say you go to the 15-minute time frame now, right? And you see a perfect discount fair value gap. Have you noticed sometimes, right? Just sometimes the market comes back to that discount fair value gap. Let me give you an example. Okay. So you have a let me give you a quick example. And I think this is gonna help you moving forward. It's definitely gonna help you in the future. Okay. Let's say, for example, this is our 4 hour CSD. Okay. Okay. So the market traded lower, the market traded higher, right? This is our change in state of delivery on the 4 hour time frame. So on the 15-minute, it would look like this. Okay, it would look like this. Market coming up a little bit, yeah. And then we'd have the purge, and then we'd have that true change in state of delivery, right? So now, Offense, you acknowledge that you have the 4 hour CSD, but you are wondering, should you now wait for the 15-minute discount rate? Let's say this is a 15-minute discount rate, resting in here from the swing low to the swing high. And you can see the market is coming down for that 15-minute discount rate. But right before the array, the market runs higher. Okay. And you never got the execution. And that is what I explained earlier by over refining. Many times over, you get people over refining from the monthly to the weekly, or from the monthly to the daily to the 1 hour, right? That is a entry right there. But then you get that people, right, that goes from the 1 hour, now they want to refine it more into the 5 minute, and they find a nice level on the 5 minute. And then just before, and they put a limit order in here with a stop loss here and a TP there. And right before the market trades into the limit order, boom, the market goes exactly to the TP. Now he has missed the entire move. Why? Because he over refined. You can legitimately use the 4 hour CSD right here as an execution. Bam. There's your execution. Here's your stop loss on the rejection block, and there's your TP. You get a nice 1 to 2. Okay. Or it's not wrong if you want to refine. You can absolutely, because the new candle opens up, right? It trades back lower and then it continues to trade higher. Now you are positioning yourself in a discount array right here. This is your discount array. Many times the market would open, trade back down lower to the open of this candle, and then run towards the TP or run higher, right? And now you've had a 4 hour change in state, you've had a small retracement, right? But at the same time, you over refined it using this. But then again, sometimes the market does go to this discount array and then trades higher. Now, I don't have the answer about everything in the marketplace, right? I don't have the answer to why sometimes the market comes for the discount array and why sometimes it doesn't, but I can 110% tell you sometimes it doesn't. And I've been the guy that missed many opportunities trying to over refine into the 5 minute, the 1 minute, the 10 second, right? Believe me, I've been there. And it is frustrating calling the move perfect, but over refining and not getting your actual execution. Okay. So that's why, remember, two different entry techniques. Structural entry, you just position yourself right here. 4 hour CSD, stop loss on the rejection block, TP2R or terminus, right? So that is your structural entry. Your refined entry, you can absolutely refine further and look for your lower time frame refined 5 minute, 15-minute sequence in here. All right. That is not a problem at all. I'm not saying it's wrong. Okay. I'm not saying it's wrong, but please understand, don't over refine. Refine, absolutely that you do. You don't look at the monthly, see a buy model, and then just execute on the monthly or the daily. Let's say this is a monthly key level. You can execute right here on the daily. This is your execution. Right here, right now. Daily candle close, new day opens up, bam, trades lower into the opening range of this candle. This is your structural entry on the daily time frame with your monthly market maker model up top, your terminus TP, right? Or you can then see the daily shift and now go to the 1 hour, find a discount ray and position yourself within London, New York session and capture the actual move. Okay. Either way, it is perfect, but I'm giving you guys examples of how you would utilize a monthly market maker model or a buy side of the curve or a weekly or a daily, and you get in after a 4 hour close or you get in after a daily close. Yes, this daily range is going to be 40 to 60 pips stop loss, right? 40 pips stop loss. This is the average daily range of EU. Okay. So between 40 and 60 is the average daily range for EU. So let's say this daily candle is 60 pips, but you get in here on 40. So you have a 40 pip stop loss, but you target 120 for the TP, right? Because you are working with a much higher time frame market maker buy model. So if you execute here and you get 3R, you are in this position for 2 or 3 days, but you capture the range. You've had brilliant success and you haven't been stopped out and you are chilling. You are not rushed or your hands and your palms aren't sweating because you're on trading a 1 and a 5 minute time frame. Okay. So I'm not saying it's wrong trading a 1 and 5 minute time frame, but at the same time, it's just there's a difference between a structural entry and capturing the move, right? And then a refined entry where you really look for that nice or risk reward opportunity because the lower time frame refined entries will yield a better risk to reward, which is why we all do it. But at the same time, don't be the guy that over refine and miss the entire damn move. Okay. So that is just something really, really interesting. But you're right, you can easily manipulate on the 1 minute if oh yes. Um, Clear explanation. Thank you. Don't quite get the answer I was looking for. Um, and now, Siri, I appreciate the Eric. Now, Siri, I appreciate the knowledge and experience you are sharing. That's why I'm here. Great material. Awesome, Eric. I'm glad you're finding value in that, buddy. How do you approach the consolidation that typically happens around 50% of the grade past power of two? This question may have gone unnoticed. Much value provided. Thanks, Calvin. Does these concepts also work in Indian markets? Samsung, I'm not 100% sure about what you mean with the Indian markets, but I'm fairly confident. Look, I've been trading Forex for the longest time, for about 8.5, 9 years. I've been trading stocks for a little bit, but always the majors on the high time frames, right? Like the big major stocks, Spotify, Netflix, Tesla, these ones. But myself, Vision, and Chris, we've started going into smaller, like mid-tier or low cap stocks recently, and I can confirm these concepts works there too. So we've traded commodities, forex stocks from the biggest to the smallest. These price action um, principles remains constant everywhere. All right. So yes, I personally believe it would work on the Indian markets too. Okay. Definitely. It works on NQES and it works on the Nikkei 225, the Japanese Nikkei 225. I've actually traded that before. Perfectly discount array, dealing range, executed and won the position. So I can't see why it wouldn't work on the Indian markets. Okay. I truly believe it would work. Um, across the board, everywhere with these price action candles. Okay, then Offense asks another question about 50% range. How do we delete this? Um, how do we remove those 100%? I don't know, Anik, if you can maybe remove these drawings. I don't know how to remove them. Please remove them. I would appreciate it. And yeah, I would have removed them. I just don't know how. Vision, are
If
you
you go to
still
your
here?
settings, yeah, if you go to your settings, you should be able to hit remove drawings. Like if you hit the annotation icon,
Oh, yeah, on the bottom. Yeah, on the bottom. There we go. Annotate. Perfect. Oh, okay. Here we go. Where's that eraser? There we go. Okay, perfect. Thank you. That was easy. Awesome. Mhm. Perfect. Okay, guys. So, Offensive, we'll get back to your question shortly. I just want to move forward with the session quickly, to where we can move all of this over and yeah, to kind of to get through the material we planned on sharing. All right, guys. So here's a quick example of a monthly market maker model, which we've seen here, right? We've seen a monthly market maker model playing out. This is that 50% of the range. If this was this high time frame sell stops, you just delete all of this. And here's that higher time frame buy stops, right? So this is the expected range that we are trading towards. And here we can see 50% of the range. Similar to any other consolidation, sometimes it's just a little bit more extended, but there's different ways how we navigate price action in there, and we will I'll get into that in a bit, but let's just move forward with this for now. All right. So
your
here we
screen
can
isn't
see.
sharing, Calvin.
Okay, let me share the screen again. Mm, share. There we go. Okay, perfect. Just let me know if it's sharing.
Yeah, it's up.
Okay, perfect. Delete all of that. Let's say this is our sell side of the curve, our buy side of the curve. We've marked it out here. You'd have a market maker model in here as well, right? This is also a market maker model, but this is just now on, it's also on the monthly time frame. But if you want to participate in this, you would look for daily candle confirmations, okay? Where terminus is resting above this. So that's buy source, but let's just call this terminus quickly. Okay, so that is terminus. Just gonna make it yellow. Maybe not that bright. Okay, that's terminus. Here's the smart money reversal. Well, that's original accumulation. Terminus is going to be the right hand side. Okay, let's just fix my spelling quickly. Just typing quick. Don't want to keep you guys up for too long in here. So let's move forward. Okay, here's our smart money reversal. Okay, here's the smart money reversal. And this is terminus over here. Can I just not have it that way? Perfect. There we go. Excellent. All right. So we can see this market maker model in here, guys. Please, I want you guys to notice this is a second stage of distributions, right? Here's a first stage of accumulation on the buy side of the curve. Here's a second stage of accumulation and also the silver bullet, right? Because if we think about the graded price swing from the original consolidation to where the market put in its low and we measured 25%, right? We graded in these quarters. We can see 0, 25, 50, 75. This is usually where we find our silver bullet towards this high, right? So this is our silver bullet, my favorite entry model as well. I'm not saying that because I'm a copycat of ICT. No, I'm really saying that this is my favorite execution or entry model in terms of accuracy, because this is quite dangerous buying the low risk buy. We've already explained this. This is now the second leg, the higher probability leg, in my opinion. We have a beautiful discount array in here with institutional order flow like down close candle supporting price higher, right? And yeah, man, it just makes for a much better, cleaner, clearer trading opportunity because we are now also 75% of the way towards the actual buy stops. So we have to think about this strategically. If the market paired up sell stops down here from a key level in here, okay, let's just say this inefficiency. Okay. If the market paired up sell stops over there, it's supposed to offload the sell stops on buy stops. It's order pairing, right? Order pairing sell stops with buy stops and buy stops with sell stops. So at the end of the day, if we understand these things, then we'd have this down close candle supporting price higher. We have the second leg, right? So we have an expansion, power of two confirmation after market structure shift, all these things. Now we have an open draw. The market traded 75% of the way towards terminus already. So why is it really going to turn around now? It's most likely not going to turn around. I can see this, you can see this, the institutions can see this. This is a super high probability trade. Okay, it's a really high quality trade. And even the low risk buy was a good trade in this scenario. It was the better entry, the earlier entry. The entry offered a lot better risk reward in that case. But I mean, if you are able to refine it and find a 1 hour entry or 4 hour entry, you can still get 2, 3 hour out of it all, right? And then if we just zoom out, right, and make the perspective a little bit bigger, we can then see where this was the market maker model, sell side of the curve, buy side of the curve we worked with, right? Now we just have the same model, but on a little bit higher or bigger perspective. So this becomes the original consolidation area in here, right? Then terminus becomes this level over here. So that is terminus, and smart money reversal remains exactly the same. Okay, so buy stops. Remember, we paired sell stops on that inefficiency. Sell stops gets paired up with buy stops. And now we can truly see the institutions confirm that through institutional order flow. Once again, in here, down close candle supports price higher, new dealing range. discount array in here, nice potential entry opportunities, and we trade the market towards terminus, right? We can see the market has reached terminus, came down. We had a nice stop hunt down here, okay? Then from here, we go to the lower time frames. Let's say this is a monthly. We'd like to go to the daily. And we would look inside of this for a nice confirmation. So in this price action, we can go even down into lower time frames, but I would not trade into a monthly array and then go to the 1 hour and look for an execution. No. If I trade into a monthly array, or whatever the case may be, I would wait for a daily confirmation first. Do we have it? Yes, we do. I personally do believe we have a daily confirmation in here. So we've had a run on sell stops, right? We've had this turtle soup. Okay. After the turtle soup, we created a new dealing range, right? So from this swing low to this swing high, that is a dealing range. We can also see a discount array in the form of a previous day low. So the market retraces inside of this dealing range, premium discount. It retraces all the way back to discount of this range. Let me just make it 0.5. Okay, so the market comes back to a discount array, comes back to discount of the range. We'll find an array soon. Don't worry about it. And then we have a run on previous day low. So the market running out previous day lows and rejecting to displace and close below the low is a major cue in and of itself. We ran out previous day low. This is Asian accumulation, London manipulation, and it started distributing higher, right? So from here, I can potentially look for any kind of power of two type of entry, right? Now, this would be if I take a structural entry on the daily. If I take a structural entry, I would position myself potentially, well, ideally, I would have waited until we break above that, stop loss here, and that's our TP, 1 to 2, for example, or we could potentially target the highs, but I wouldn't be too confident in that at this point in time, okay? Let's just go down in here to the daily, or the 1 hour, sorry, because this is a daily time frame. We'd have to find an execution, one or two places. Either we buy Asian low here or we position ourselves the very next day. And this is where the entry models comes in. But we don't have we don't have the time to go into the execution models. We have two, as I mentioned in the beginning of the stream, we have two high probability entry models that we trade on a daily, weekly basis, which houses everything together. It's already refined and all that goodies. And I can literally see this is model one. Okay, so model one, I have two opportunities I can execute in this week on a London or New York session. Model two is I wait for open because we already expect this to be a classic buy day. And then we have our criteria execute below midnight open, previous session low run. There's definitely entry execution opportunities in here, okay, on the lower time frames. This could have been a structural execution where you just use this as a protected low. And once again, we don't have time to go into protective highs, protected lows. We don't have time for all that now, but we will go into depth in all of these things in the boot camp. So that would be similar to something we would trade as a structural entry, all right? Or you could potentially execute right here as a structural entry with a stop loss below this, and then you'd be able to get out for 2.5 or somewhere in here. Okay, so yeah, we would have missed it there, but nonetheless, the market still trades high because we know the general trend. Anyway, so let's just see if we can just find something there on the 1 hour. I'm not going to go super in depth, but let's just see if we can find something in here. Okay, this is a lot of consolidation, so probably not. That was that daily close. No, probably not on the 1 hour. No, it's not ideal. I could potentially frame something down here. Yeah, if this was sell stops, we have a bullish draw, we could potentially frame something in here. That wouldn't be an issue. This would also become a launch pad for higher prices. Okay, so that's not an issue. Unfortunately, not a greatest example of a nice execution. Let's take a look at the weekly quickly. Okay, this is a potential opportunity that um, we've utilized or looked at last year. All right, perfect. So this we can clearly see sell side of the curve, buy side of the curve, right? We have open draw right here. And we really just want to position on the silver bullet as explained earlier. If we can capitalize this small portion of the range, which is the silver bullet, well, that's really great. Okay, so here we can see we have a nice dealing range. Sorry about that, guys. Okay, here we have a dealing range, right? This is our dealing range on the weekly. Then we'd go to the 4 hour. Okay, so this is the range we are working with. I think I skipped. I see a 4 hour inefficiency there, but I just want to make sure. Yeah, okay, perfect. Okay, so here's our 4 hour discount ray. It's not really in discount, but it is similar, right? It's not perfectly in discount, but it is around equilibrium, which is okay. We still mark it up and we still pay attention to it, okay? At the other side of things, we could potentially use this um, as a potential mitigation area. Okay, so let me just mark this up as a mitigation area, right? And we can see the market, let me just remove that. We can see the market runs into the mitigation area. And from here, this is also now we have to keep in mind, this is a previous week low. So the market trades down, takes out a previous week low, and we get a weekly close back in the range, right? So the weekly close is somewhere around, I would potentially say, somewhere around here. Yeah, Friday. That's the Friday close. Now, everything in here, unfortunately, is a little bit ugly. But from this discount rate, we have a new dealing range, right? And yeah, I can frame a execution. Really straightforward. So it's unfortunate that the two um, examples we've looked at there wasn't really good. That we have this ugly price action, right? But this is still valid, right? Bullish range, market comes out, runs out previous week low, then creates new II, right? Perfect. So we know if there's still an open draw, all we do is we look for a nice discount rate area, and we would like to position ourselves in discount of this leg then, because we've got a weekly candle closure that looks like this. Okay, so this is our weekly candle close. And we really just look for that expansion on the next weekly candle. So we can position ourselves, let's say, in here, we can position ourselves in here, stop loss below this level, and potentially target 2 or whatever the case may be. Unfortunately, this is not the best examples. I would rather prefer to use this as a example because unfortunately the market is really choppy price action in there, but this is really a better execution or a better refined execution. Okay, so it's a little bit unfortunate that or JPY doesn't really give us that nice ranges that we can work with in here. But I mean, silver has added this week. This was really nice. We can take a quick look at UK oil and crude oil as we've been actively trading this for quite a bit. Okay, so this one's here is Model 1. I'm pretty sure you guys would have seen my executions in here on US oil and why I've executed this long because we've had this market maker model in here on the, I believe it was the weekly time frame or the daily. But nonetheless, mm, okay, we have this. Let's take a quick look. I don't know where I've marked it up better. US oil on the daily. No, it's not here, so it must be CL. Okay. So here we have a smart money reversal, right? We have the market reaccumulating in here, manipulating. Then we have this nice change in state of delivery, a nice dealing range in here. On the weekly time frame, we run out a previous week low there. The market then trades back bullish again. So here's multiple entry opportunities in this market long, and we have been taking positions in the elite chat or in the live streams over the past couple of weeks um, to really capture that move. And I'm looking for a quick example of that in the group. Let me find it. US oil. Okay, let me copy this. The image. Okay, let's save this. Mm. Let's see if it would post now. It says the image is too large. Let me see if I can post it in the chat. Awesome. So I think we should round up this session here, guys. And just taking a quick look at this, this is a potential continuation entry, right? And then once again, the market reaccumulates. We've had a bullish draw, this one over here. So from here, we targeted this high. Okay, so it would make sense why we positioned long. You guys will see we positioned long in here in this down close candle, and once again in there. Three positions which we've accumulated multiple times. The market ran out higher towards this. You guys will see the TPs. I will post it in the chat shortly. And then in here, we have positioned again in there towards there. All right, or in here towards there. So it's not too difficult in that sense, following price action on the days and finding a good entry inside New York or London session. That is really not too difficult. And we have models and everything. We just don't have the time to go into all of it now. But at the end of the day, once you have a pretty clear um, level that you are working with where order pairing takes place, you see the nice dealing ranges form from those levels, right? From here to there, then coming back to this down close candles supporting price higher, second CSD in here, potential structural entry there, stop loss down here. The first TP would be 2R, potentially looking for this one, and then this one overall. So let me post it in the chat quickly because you guys will see we've taken multiple opportunities. There we go. Okay, it's working. I've posted my US oil recent trading positions in there on the chart, and yeah, so that's how we've captured majority of these moves in long and accumulated multiple orders over a time frame or over a span of time in there and really captured it, the majority of it towards 70. 70 was my exit. So this level right here, 70, was my actual exit down here. All right, so thank you guys for being here today. Unfortunately, market maker models is such a vast topic that we don't have time to go into all of it in one session. And that is exactly why we have the boot camps to really study these things together with an appropriate amount of time, which allows everybody to grasp these concepts fully. So thank you guys for being here. I really appreciate it. And if there's any questions, you guys are most welcome to ask. The boot camps will kick off next week, I believe March the 13th or 14th, next week, Friday or Saturday. So I'm really excited for that. I'm really excited to see you guys there. And there we will dive, obviously, into all the details and topics we don't really have time to cover today. So yeah, awesome guys. Thank you for being here. This session has been going on a bit longer than anticipated. But yeah, man, as mentioned, there's a vast amount of information in all of this, and we can really try to simplify it. But market maker models is really a topic that many traders struggle with. So you can't really simplify it too much. Otherwise, people will have a lot of other questions. But it's also so much information that you can't really leave the important stuff out. But there's a ton more to really go into, in all honesty, if we really want to get technical and find that special entries. Um, awesome, guys. Thanks for today. The vision. I don't know if you want to say something, add something.
No, I just dropped the link to join the wait list if you guys are interested in that.
Excellent.
Yeah,
Awesome.
Calvin's going to be dropping some more material in the waitlist chat this week ahead of boot camp. So be sure to join if you want more of what was spoken on in the call.
Awesome. Thanks, Vision. Should I make you the host of this session or could I stop the
Yeah, no, it's
session?
good. You can stop it now.
Okay, perfect. Thanks, guys. It's a pleasure, guys. See you guys again in the chat in the Discord this week. Bye bye.